Good morning, everybody. Welcome to another Wealth Watch. I know it's been a little while since we last connected, but we've got a lot to cover, so I'm not going to do a lot of preamble today. Quick bit of housekeeping. If you notice boxes in the background, we are on the cusp of our move. So we're going to be moving offices here in downtown Lexington to 106 West Vine. So don't be fearful of any of our presenters today being let go and packing up their office. We're just moving to our new building. With us today are James Fereday, Tim Yessin, and Bud Watson. Good morning, gentlemen.
Morning.
Morning.
And what we'd like to do over the course of the next 20 minutes is just have a somewhat quick discussion about what we're projecting, what we can expect once we get on the other side of November 3rd, or once we find out the results of what occurred on November 3rd. We're going to take the first part of our time today and talk about, in terms of the election results, how have they impacted the markets in the past? What are some misconceptions that people might have about how election results impact financial markets? And then we're going to shift gears and talk a little bit about planning, what we see coming down the road based on some different scenarios, and then conversations that we're looking to have with our clients based on those outcomes. So as always, the Q&A is open, so feel free to send in your questions, and we'll try to tackle those as we go. But just to kick it off with a pretty easy question, James, who's going to win the election?
Oh, but very easy. Definitely going to be one or the other.
Got it.
Guaranteed.
Kanye West.
He's left Kanye out.
Yes. No. There's Clint. There's a ton of uncertainty around these elections, and I know we've discussed internally as a group. Just we've had a lot of clients calling in, worried, concerned. Either way, is there going to be a blue sweep? Is Trump going to remain in the presidency? So we've seen, both sides of the house there, and I think that uncertainty is pretty understandable. And with COVID-19 basically being with us this whole year, I think that uncertainty level has actually increased as well. So I know we've got a few slides to share with our audience this morning, and the first slide is just a look at different ways to look at who might be ahead in the election over the other, and as you can see, there's three measures here. The first one at the top is a betting average, so people are actually putting down money on who they think is going to win the election, and you can see it's been all over the map here over the last year, and right now Biden's got the edge, but certainly within the margin of error. The second chart down, or at least the second chart in this particular slide is the traditional polling. And you can see again here, that's been pretty consistent over the last year to where Biden's had that edge, or the Democratic Party has had that edge. Again, within the margin of error though, and certainly some of those swing states are very much even closer within that margin of error from traditional polling. But as we all know, in the last election, those traditional polling measures didn't always have it right. So some uncertainty there as well. Then finally, what I like to look at as well is a basket of securities that is tied to one candidate over the other. So what stocks might do better under a Biden presidency versus a Trump presidency? And you can see here, it looks like the Biden group of stocks right now is performing at a higher level. But again, just we use this as an illustration just to show there's different ways to look at who might win the presidency, but still a lot of uncertainty out there. And that uncertainty breeds volatility, right? And we've definitely seen not only volatility from COVID-19, but as we've built up to the election, we've seen that volatility increase as well. So from an investment standpoint, it's very difficult to time trades based on the outcome of the election. So we're not, as an investment group, we're not making any strategic changes right now. We're just not in the business of trying to time the market from a political standpoint. Now, on a tactical basis, we'll certainly look at post-election, there may be some tactical moves that we may based on the outcome, but we like to base our changes on the fundamentals. So interest rates, valuation, earnings, those are really driving those tactical decisions over time. The other thing we've noticed, and I think Clint's brought up the next slide here, is that expectations around. Have you got that? Is that next slide up?
Yeah,
Clint?
that's pulled up, James. Yep.
Okay. So we wanted to go back and look at how the market's done under different scenarios of government, and often the market performance doesn't always match up with people's expectations around those political outcomes. So what we've got here is three different scenarios. The first scenario is how is the market done under a Democratic president or a Republican president, and you can see here the Democratic presidents have the edge. But if you've got a Republican president, next bar chart over, with full congressional support, the Republicans have the edge. If we go to a split government, you can see the Democrats have the edge again. So this is not a political statement at all. We're not advocating one party over the other, rather just looking back at the historical data, and this is what we've seen.
And James, I think it's a fair statement here to point out, these are just snapshots of different levels of control, but they really don't indicate what the party in control prior may have done, what the timing was on when people took over. So just reinforcing, we're not necessarily making a political statement here, just
right.
These numbers probably don't line up with what most people would have expected.
Yeah, more often than not, it's the build-up to the next presidency that really sets the stage from a market standpoint. And we would argue it's the overriding macro environment that really sets the next president up for those next 4 years. And I think particularly important right now, we've just been coming out of this huge bear market in March, April, where COVID hit us very hard. We've had a very speedy recovery on the other side for the markets, not necessarily the whole economy, but for the markets, we have had that. We have a huge stimulus package that was passed. We're looking at another stimulus package that probably will get passed. May not get passed before this election, but it probably will get passed at some point down the road, no matter who's the president. We're going to have some easier comparisons year over year from an earnings standpoint. Looks like GDP, again, is going to be higher than we've seen in the last few years, simply because we're coming off a lower base. So there's a lot of factors out there that's going to help whoever wins the presidency. The markets are really going to be out of their control, particularly for the first 12 to 18 months out there. So fundamental, just to highlight, really fundamentals and the overriding environment really tend to have a larger impact on the market more than individual presidents.
And I think the next chart that we've got probably paints that picture a little bit better. So I'm going to pull that up, and if you want to speak to that.
Sure. Yeah, I think we've probably all seen sort of similar charts of the markets over time. This is just to illustrate that markets tend to reward long-term investors over time. So I thought it was interesting. I was looking at some data points actually in the Wall Street Journal this morning. Some of our clients out there might have seen it, but in years where one party has been in control of the presidency and Congress, markets on average have gained 7.45%. In other years, they've gained around 7.26, and they've risen and fallen almost identically in terms of the number of years out there. So this just illustrates, markets over time have definitely rewarded long-term investors. The one thing we can guarantee is in every single presidency we've had a market correction. So we've had a 10% drop from peak to valley in every single presidency. So unfortunately, that's the one thing we can guarantee. But again, just to highlight, markets and fundamentals tend to be more in control than individual presidents.
And James, I think this is a good chart to just highlight. This is the reason that we stay true to to our discipline, and our discipline doesn't really change from an overall strategic standpoint because, as we can see from this chart, the market is moving up regardless of who's sitting in the big chair.
Right. And look, we will make tactical adjustments. So no major strategic adjustments, but there are certain industries, certain sectors that certainly might do better under a Biden presidency than a Trump presidency. So we'll tweak around the edges. And I thought it was also interesting. We don't have a chart on this, but over the last 12 years through through Obama's presidency, and then through Trump's presidency, similar sectors have actually done pretty well. If you look at the sector breakout, how they've done under both administrations, it's been similar out there. And I would point to the fact that we've been in an environment that's been a low growth overall environment, low interest rates, low inflation. That's been consistent throughout most of those time periods. So that's really driven the performance in the market versus who was in control of the presidency.
So if it's fair to say we're somewhat agnostic just from an investment standpoint on the winner of the election, is there a bad scenario, a worst case scenario from our viewpoint?
Yes. So worst case scenario is a contested election. So if the longer it drags on, I think the worse it becomes from a volatility standpoint. I think we'll get at least a 10% type of correction if we still don't have a president come, December. So hopefully that we have a clear outcome. It's not contested. If it is, we've got a chart up here of how that process would work. But if it is contested, we certainly would look at that as potentially a buying opportunity into that weakness. But if you look back at the Bush-Gore hanging Chad scenario where we had uncertainty and there was a contested election, market sold off 7-8%. So I do think it would be higher than that kind of a sell-off.
Got it. And for those of you viewing live, or if you're viewing later today or later in the week, we're going to have these slides available on our website. So if you're viewing online later, or you're having trouble keeping up with some of what we posted today, just check back on our resource page on our website, and you'll be able to access the slides that we've discussed. Well, James, thanks for the overview on elections and potential investment impact. And as I said at the outset, we're going to switch gears now because there's really two pieces to this. One is, how does this election impact investments? But then the second is, how does this outcome affect what we do with our clients in terms of planning, in terms of strategizing on their financial future? And so, Bud, I'm going to bring you in here, and I think, similar to the discussion that we were having with James about what does a Biden win mean? What does a Trump win mean? What does control over here mean? Maybe just walk through quickly what status quo means. We get on the other side of election day, and Trump is still in office. Republicans still control a vast amount of government. What does that look like in the first couple of months to the first year in terms of how we're interacting with our clients?
Yeah, thanks, Glenn, and good morning, everybody. Yeah, as is the case with most re-elections of an incumbent, the status quo is a lot easier to deal with than a change in the control of the White House or Congress. But an important part of the re-election of President Trump would be, and I think this is really meaningful for people to understand, is that a lot, if not the majority of the more significant provisions of the Tax Cut and Jobs Act that was sort of the cornerstone, or one of the cornerstones of the president's first term, that was enacted in 2018, most of those provisions sunset at the end of 2025. And by sunset, that means that these provisions, and they're listed on the screen there, and there's many others, these are just the most dominant ones, those provisions will automatically go back to how the law was before 2018, without any congressional action, without any executive action. And so we're set to have all of these benefits of the 2018 Tax Act expire in 5 years. And what the president has proposed is to make these changes permanent, meaning they won't sunset at the end of 2025. That's really significant because that affects a lot of planning, particularly the last bullet point when you talk about estate and gift exemptions. Knowing that those would be permanent would impact how we look at financial plans and so forth. So I think that's the biggest thing for the status quo, Clint, would be the permanent nature, potentially permanent nature of all of these sunset provisions.
Sure. And I mean, obviously, as the status quo implies, obviously we wouldn't expect much to change if we keep on pretty much the same path. But Tim, I'm going to bring you in here. Let's say we see a pretty substantial change, change in the executive, maybe change in congressional control. I know we're looking, most people kind of immediately glom onto taxes, right? But obviously, when we're talking about wealth plans, we're incorporating living through retirement, we're incorporating what, like Bud mentioned, estate planning. Talk a little bit about some of the impacts that we're foreseeing in a pretty sweeping change in terms of government control.
Sure, thanks, Clint. The main thing that we've got to go with is what we know now, and speculating on it's always tough to do ahead of any dramatic changes. So if we do get a blue sweep, we do think, as Bud had mentioned, some of these sunset provisions will come into effect. But we've got to know, we've got to work with what we know, and until those changes are incorporated, we've got to stay the course and do with what the laws are currently. So I've got to make that caveat because we don't want to make a whole lot of changes until we know, in fact, what's coming down the road. And when you look at these, I know when Bud and I have been talking about this for a while, and the tax planning, we can anticipate a lot of changes. Again, we're talking about a blue sweep or some significant change in the status quo. Bud and I talked a lot about this, and I know Bud and I agree with you completely. Tax planning is going to be the biggest issue that we can count on when we look at some changes to planning. And so, Bud, take us through. Tell me a little bit about one of the big things I think that's on a lot of people's minds, at least in talking with people recently. We've got this unified credit from the estate tax right now, and it's rather high. What do you expect from what you've heard, what you've read from the Biden plan if Biden were to come in and make changes to that unified credit?
Yeah, that's probably, Tim, our biggest overall concern. And that credit, if we go back to the previous slide, Clint, is the concern there would be if we talk about the sunset provisions and President Trump making them permanent, the sort of the flip is true of potentially of a Biden presidency, is that his particular administration could not only not make those provisions permanent, but could accelerate the sunset up all the way forward to January 1, 2021, potentially. Now, obviously, that takes action in Congress, but accelerating an actual sunset is a little easier sell because his position would be, look, I'm not changing the law, I'm simply accelerating a change that's already in the law. So we would have some concern and really need to keep our eyes on the ball on the potential for the estate tax exemption to drop back to the previous, again, I mentioned it goes back to prior to the 2018 law. If he were to accelerate that sunset, we'd be back to the 5 million plus inflation, which would be about, I think, 5.8, right, or maybe even 3 or 3.5 million. So suddenly a lot of clients who were sort of relieved of having to think about estate taxes a couple of years ago are suddenly back in the game again and having to redo and rebuild some estate plans.
And that 5 million, right now we're at 11 million per person, correct? And you're talking about 5 million per person. So a couple would have double that.
Yes.
Gotcha.
Yes. So it's roughly half. So it's a little less than half.
Gotcha. Good. Well, let's talk a little bit about some of the individual tax proposals that are coming out and what that might mean for example, I know there's been a lot of talk about 401k deductions, that there might be a change on the 401k side, and also on the individual marginal rates. Take us through some of that stuff.
Yeah, some of these changes again that are sort of filtered through here are part of the repeal or the acceleration of the sunset provisions. Some are not, like the increase in the corporate rate that Biden has proposed from 21 to 28. Well, that corporate rate change that President Trump had made is permanent. That one does not sunset. So that 21% was made permanent. So that rate increase to 28, individual rates really going back to what they were pre-18. So that's kind of an acceleration of the sunset, the 39.6. But there's some substantial changes, mostly on high income taxpayers, sort of described as the top 1%, although I'm not sure mathematically it works out to that, but over 400,000 of earnings, which is not defined yet, you would see some significant changes in rates. The Social Security tax, the 6.2% that we all pay up to 137,000 of wages would sort of have a donut hole, and then it would restart. So you would pay no Social Security tax on your wages between 137 and 400, but then you'd go back to paying the 6.2%, both employer and employee, over 400. So that's a very significant number on high wage earners.
Would that go back to $1 on a $400,000 W-2 earner? Or would that go,
No.
They still have it would just be
No,
marginally?
there's still a donut hole.
Gotcha. Okay.
So we have this sort of odd $200 and some $1,000 amount of your total wages that would not have that Social Security tax. And of course, these are all just proposals, that are made now, and the law itself, as enacted, could have none of this or could be totally different than this.
Sure.
As you mentioned, the 401k contribution, Vice President Biden has suggested that to make the value of 401k and potentially IRA contributions as well, and other retirement plan contributions, frankly, even for all taxpayers, to just use a flat rate, a credit really, so that for example, everyone would get a 24% benefit of a 401k contribution rather than it being deductible at your current tax bracket, which in that view would say that a high wage earner gets a greater benefit from a 401k contribution. So most of these things, as you mentioned, I agree, Tim, you can't really plan. It's unwise tax-wise to do tax planning on what may happen. That's a very dangerous road to go down. I think it's valuable, though, particularly with some of these significant ones, the estate exemption, the real estate, the like-kind exchange elimination, the third bullet point from the top. I mean, these are things that really we need to have front of mind, particularly if Biden does win. We need to kind of really start thinking and analyzing and tweaking plans pretty immediately. In some cases, possibly before year end, but I think certainly going into next year.
Sure. So when we're looking at this, I know you alluded to this before, we do have to go with what we know now. And what we know now is nothing has changed. The potential there is certainly, the potential is there for change in the future, and we want to incorporate those changes. And our software is up to date as things change. We do change our software daily when these change, particularly when we get something, the potential for something next year, early next year. So again, it's probably going to be a good time to revisit your plan next year, just to make sure you're on track, and look at some techniques on the savings that might come about, or some strategies that might come about because of those changes.
So Tim, for those people watching, maybe timeline that. I mean, is this something that if I've got my wealth plan with WealthSouth, or maybe I'm considering doing a financial plan, is this something I need to do in January? before I file my taxes? Is this what's the timeline to revisit this after we know the outcomes?
Once we know the outcomes, I think that first quarter, after we know the outcomes, we'll start getting a legislative agenda from the president, and I think it'll be outlined pretty clearly which direction they're going to go in. Again, we're talking about non-status quo situation. So if Biden were the president, that's obviously the non-status quo here. So once he gets in office, I think his legislative agenda will be outlined fairly quickly. And we can start incorporating some of those changes as the laws are passed or the rules change as well as we move through. So first quarter after those have been communicated, I think is a good idea. And certainly by the end of next year, absolutely positively revisit the planning side of it. And as things change, as major pieces of legislation may be passed or rule changes made, we certainly need to revisit those every single time.
Very good. And but as a CPA, if our clients just want you to do their taxes for free, you're more than willing to do that, right?
I would do that, yes, sir. And I still do them by hand, with pencil and eraser. So one thing probably worth pointing out too, to make clear, if Biden wins the presidency, but Senate control stays with the Republicans, it's unlikely that any of these changes, or many of them, will get enacted. He'll have a hard time getting most of these items through the full Congress without Senate control. So that's also a significant part of this whole analysis.
Very good. Well, gentlemen, thanks to each of you. That was a very informative half hour. As I mentioned at the outset, the slides will be captured on our resource page right next to the video. So if you're watching this and we went through things too quickly, or you just want to revisit some of the data that we've gone over, feel free to go to our webpage later today, and that should be uploaded. Thanks again for joining us. We'll see you next time on Wealth Watch, and have a great weekend. Take care.